there. Out of this total number, one additional, one reduction will be there. That's a green energy, which I said in my opening statement, that we will be putting another 10 to 15 megawatts of green energy. So roughly around 60 crore will get, roughly 60 crore will get subtracted out of that. So overall, put together all these things, you will, the balance amount will be in the knitting, weaving and processing.
Okay, sir. And sir, you mentioned our tonnage at 33,000 tons per annum as of now, which will get expanded by 25,000. Sir, I missed that number. So the resultant quantity will be 58,000 with the completion of 25,000?
No, Saketji. I said 33,000 was in 2024. I said this 25,000 spindles which we are getting added next year. This will add another 7,000 tons. So the total number will be 40,000 tons.
Oh, yes, sir. I missed the spindle quantity with tonnage. Sorry. I missed it. And then, sir, how will what will be our debt equity ratio when as we are embarking on this 1,000 crore rupees journey, where already capex where 350 is already spent, and I think so our EBITDA for the quarter has been around 28-29 crore. So 120, 130 should be the EBITDA number annually. So we are looking for borrowing, sir, then going ahead to fund this capex, or how are we going to fund this capex, sir, and what would be the debt equity ratio?
So first and foremost, Saketji, this calculating this number of 120 and 130 is kind of not the right number.
Okay.
Because this is on the stage where we are on the bottom of the pyramid on the margin side, because it's the overall industry situation. I don't think this situation will continue for a longer period of time. Right? So like I said, in the long term, our margin expectation should be not less than 14 to 15% minimum. And which I call it is a normal EBITDA, even if I don't consider all the initiatives which we have done or we are likely to take. So the number will change, number one. Number two, you know very well that today we are on a net cash basis. No working capital loan, no debt on the balance sheet on the fixed asset side. We have a strong leverage possibility into our balance sheet, and we will maintain the discipline of 1:1. Still, we have a big headroom to invest. So all this planning is based on that. So we will remain in the 1:1 debt to equity ratio. Yes, we will raise the debt, and definitely our margin will also improve, and ultimately it will kind of create a better kind of a return, a better kind of a debt equity also.
Sir, when you alluded to the fact of unrest at Bangladesh, so that is a temporary phenomenon, and that has created in the immediate future some demand issues or some supply issues. This is the reason why the arbitrage, that means from the cotton to the yarn spread, has improved. That is what you were alluding to, sir?
No, Saketji. What I was trying to indicate the difference, that in Bangladesh, because of all these disturbances, there are many mills which are decided to kind of close down. Sort of the garment mill, decided to close down. How that situation turn out, we don't know right now. But this has created an opportunity for the Indian garment manufacturers in a longer term basis. But because of the capacity constraint, probably we may miss out some of the opportunity which may go to Vietnam or Cambodia and things like that. That's the point I was trying to say. But maybe that may not also, I may be wrong at the time. Only the time will tell that.
Okay. But we are of the opinion, you being a veteran in this industry, sir, is of the opinion that the spreads are definitely going to improve from where we are. These are at the bottom of the cycle.
100%, Saketji. See, no, this is not something which even we need to predict, because on these margins, no new investment will come in. This has to improve. Because any business, if it doesn't have a return on capital employed of 14-15%, how long you can sustain on that business? And if you don't have an EBITDA of 14-15%, how can you sustain? Second, as you know, a lot of consolidation is happening in this industry, and obviously that will also be an opportunity. Because of this consolidation, the marginal players will get vanished, and this will also help to kind of improve the spread. So in the longer run, medium to longer term, definitely the margin has to improve.
And last point, sir, I may be wrong, correct me there. We have, sir, any valuable real estate that we house under GHCL Textiles post this demerger exercise, and how should that asset be valued, or what would be, how are we going to sweat that asset? Any land parcel, or if you could just elaborate.
Sakshi, all the assets are already accounted for in the balance sheet, and you know that we have a very healthy balance sheet, and that balance sheet is at this point of a time does not have any kind of a debt or any kind of a, even the book value of the business is much healthier.
No, sir, I was just alluding to a real estate that currently is housed under GHCL Textiles, and that can be monetized, or that has a higher market value than the one which is there, because that would be at book value for us. So I was just alluding whether we hold any valuable real estate asset which is not for the operational purpose.
See, Sakshi, we do have, but we don't have any plan at this point of a time, kind of a. We have not given any thought to that, okay, how to monetize them. Because we have an opportunity at this point of a time to how to kind of grow our business at this point of a time. We have possibilities of debt raising. So we have more priorities at this point of a time than looking at this. Okay? Sakesh?
The line from Sakesh has got disconnected, sir.
We can come to the second.
Okay, our next question is from the line of Chirag Jain. Please go ahead, sir.
Hi, sir. Thank you for the opportunity. Sir, just to clarify, the 18 to 20% EBITDA which you are trying to target for the integrated product by getting into weaving is knitting. So it would be due to we being integrated manufacturer from spinning to end product till dyeing to getting the end product. Is that right understanding?
No, Chirag, let me clarify again this. As I said, don't link this margin with the current margin, because the current margins are not a realistic margin for this kind of a business. And historically, last 15, 20 years and 5 years, you take any average, you will find that our margins was in the range of around 15%, 14 to 15%. So I'm assuming this 14 to 15% margin in a normalized situation will happen. And as I just now said prior to this answer, that in the long run this margin has to come, because otherwise the business sustainability of the business will not be able to justify. So that is going to come. And the way we have structured this business in our cost competitiveness in terms of our solar and green, wind power portfolio, the way we have built our value-added segment, the way we built our labor and all the cost measures. We are very highly competitive on that. So that all will add to this 14 to 15%. Balance incremental, which you are rightly talking about, will come because of scale of operation, because of your weaving, because of knitting, and because of your process fabric. So we are looking at a gap from 14 to 15% to 18 to 20%. And that we will be able to add because of this initiative which we are doing.
Okay, got it. Next was on the on the expansion that we are currently doing of the spindle capacity. So the average cost of expansion is coming around 86,000 per spindle. So do we have any extra infra for the future purpose is that the reason why it's on the higher side, or is it that some new technology that we have implemented? So can you give some color on that?
Sure. Two things. One, this project, we are putting a very state-of-art project, which is completely 100% retail project, which is where we don't have a kind of a mix and match of some domestic machines and things like that. State-of-art project will be there. The second is a highly automated plant. Thirdly, this is a very coarse count there. Like I said, with a 25,000 spindle, we will be producing 21 tons. If you calculate on the basis of our current capacity, you will find that numbers per spindles are much higher, right? So these are the reasons because of this, capital cost is on the higher side. However, in addition to, as I said, some which is not going to be very significant we are building the infrastructure for 40 knitting machines into the same in the same building, the same compound, and there will be no capital cost of the building and the thing for those machines. So to that extent, you can say the numbers will be there. If you remember last year, we invested 40,000 spindle, and our total investment was roughly 250 crore, 260 crore. So 260 crore, 40,000 spindle, right?
Yeah.
So it's about 65,000. Right?
Yeah.
Now it is coming to 86,000. This is primarily, as I said, and this 40,000 spindle which we added, that also gives me 21 ton capacity, and this 25,000 also will give me a capacity of 21 ton.
Okay, understood. That's the thing. Got it. Sir, lastly, if because I joined a bit late, if I missed out on the spread. So I had a question that what were the spread of previous quarter and this quarter for us?
I think, let me, since you have joined later, 126 was the last quarter, and this quarter is 122.
122, and previously?
126 last quarter.
Okay. So the spreads haven't moved for us.
Yes, as compared to last quarter, no. But if you look at the same quarter last year, it has moved from 96 to 122.
Okay, fair enough. Because I was trying to figure out because the other players have reported a Q-on-Q increase also in the spreads. So that's the reason I was asking that. So any color on that? Why we haven't?
I've already answered this question. I think this just two questions before I have answered that question to, I think Mr. Amit or someone. I have answered that question.
Sure.
So I have already answered that question.
Okay, thank you. That's all from my side, and all the best. Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and one to ask questions. Our next question is from the line of Jatin from Swan Investments. Please go ahead.
Thank you for the opportunity once again. So just wanted to know now, when you have guided in next 3 years, our revenue will be doubled, so from 1,000 to 2,000, and probably we're doing 15 to 18% of the margin. So at that point of time, what type of return ratios that we are looking at it? Because if you look at current return ratios, we are around 5% or sub 5%. So how shall we look at the ROE and ROC over next 3 years?
See, Jatin, as you rightly said, and one of the areas where we are working on that is that how do we optimize our working capital management. See, basically, Jatin, what happens in this business historically, and you will find because of that there will be a difference between the return on capital employed of various industries, various companies. Okay, historically what we have been doing is that we were covering the cotton in a season, and we have a long working capital need for those cotton. Keeping two things into mind, one is the quality of the cotton, and second is the volatility or always the trend of last 15, 20 years, barring few years, seeing that in the off-season the cotton prices are going up, right? So that's one. So you have a large capital, and you add that working capital on that, and based on that, what happens is your return on capital employed goes down. Because you get the loan, you get around 7 to 8%, and by calculating, you are adding that number, and therefore return on capital employed goes down. If I have in the synthetic side of the business, then that concern we don't have. So if you are in the cotton industry, you will have a different ROCE, and if you are on the synthetic side, you will have a different. And if you are in the value-added segment, like your weaving, knitting, and all those things, your return on capital employed will be different, because in that case, you are going into the second stage of the value addition, and the working capital remains the same. You don't have to add the working capital. The next point, yes, we are also working. How do I optimize my working capital? And that is probably in next few quarters, you will see that sense of more optimizing our capital allocation towards the working capital, and that will improve our return on capital employed. My target will be in the first stage. My target should go to double digit, means around 10%, 11% kind of a. And historically, we have been getting that. So to that extent, I think by these two things, we will be going to that stage, and ultimately it should be around 15%. At least we should have a return on capital employed. Once we complete this journey of knitting, weaving, and process, we should have a return on capital employed around 15%.
So, sir, is it fair to assume that by the time our knitting fabricing comes and when we double our revenue to 2,000 crores with 15-18% margin, our return ROC will be in the range of 10 to 11%? That's it.
No. I've said that on the immediate basis, next few quarters, it will be around 10%. But as you rightly said, once we complete this stage by stage, this improvement will start happening, and ultimately we will reach to 15%. It's not that from 10 to 15 it will reach only at the end. Gradual improvement will happen.
Sure, sir. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, you may press star and 1 to ask questions. Our next question is from the line of Uday Kumar from SMIFS Limited. Please go ahead, sir.
Hello, sir. Am I audible?
Yes, sir.
Can you? Yeah.
Sir, just the 40,000 spindles you are adding, it is started, the commercial production has started?
Sorry, your voice is not audible properly. It's a lot of noise. I don't know. I'm not being able to understand your voice.
Sir, I was asking about the 40,000 spindles. The commercial production has started, or it is yet to start?
No, it is already started last year itself. The full benefit will come in this year, and that's the reason you have seen in the first quarter, our number has gone up. Even in the last year also, in the March quarter, the reflection of that was there.
Okay. And sir, the 25,000 spindle will be operational by next June 25, right?
Yes.
And just on the revenue side, you said that you will double the revenue by in 2 to 3 years of timeline. So roughly 1,000 crores of capex and 1,000 crores of revenue. So the asset turns comes around 1, right? So seeing the industry, it's a bit lower, like in industry, like 1 to 1.2, 1.3 should be the asset turns. So where are we lagging behind, sir?
So you rightly said that. Basically, depending upon which segment of the market you are, your number will change. Okay. If you are purely in the spinning side, your ratio will be 1:1 generally, and if you are in an average count, again, these are all technical things. If you are an average count of 40, your ratio will be different. If you are in a quotient count, just now I said, if you look at our 25,000 spindle, my project cost is 200 crores or 210 crores. My revenue will be 250 crores. So it all depends on which segment you are in the market, and if you add to the weaving, knitting, and things like that, your ratio will definitely increase to 1.3. So when I said 2,000 crores, my number was not 2,000 crores. I said I will increase the revenue from the current year. That means likely number should be something around 2,400 crores kind of a number should be there when I'm talking about the doubling the revenue from here. Because 1,200 crores will be my revenue this year.
Okay, sir, got it. So just one more on the margin side. I assume the spinning margins would be around 14 to 15%, and you added 18 to 20% margin. That will be coming from the fabric side, right?
Yes, let me repeat this here. Basically, as I said, on a longer term basis, we have achieved a margin of 14 to 15%. That we are assuming that margin will come back. Second, I said that many things which we are doing, green initiatives or the green power. Second, I said value addition, moving the commodity to the value added segment. That is the second thing. Third, I said knitting, weaving, and the processing. All this put together will take us to around 18 to 20% margin.
Okay. So, sir, you said that and you also said that you wanted the fabric share should be 40% of your top line. What is the current share right now, sir?
Currently, hardly 5%, and that is also on the outsource model. We don't have our own infrastructure on that.
Okay, the 40% will be wholly integrated, right?
The 40% will come once we have all the infrastructure of your knitting, weaving, and processing and all those things.
Okay, and expansion of the spinning, knitting, weaving, this all will come after this June 25, right? After the spindles, 25,000.
Yes.
Spindles.
Yes. First, we are completing this 25,000 spindles. In the meantime, we are getting finalized, and we are already on the outsource model. We will increase our volume or our percentage of the 5% in the outsource model. It's not that we will be stagnant on the outsource model only up to 5%. We are trying to increase this percentage on the outsource model, and then subsequently we will add this infrastructure, and we will go to the 40%.
Okay. Thank you, sir. Thank you for taking my question.
Thank you.
Hello.
As there are no further questions from the participants, I now end the conference over to the management for closing comments.
Thank you very much for all of you for participating, and I can only assure you on behalf of the complete management of GHCL Textiles that we are trying our best to improve upon our margin and to grow. Our capital allocation focus will always be on deploying in a meaningful manner so that we can get the best return out of that investment. And the journey of 20 years or 25 years in this spinning business, I'm reasonably confident that we will be able to meet your expectations. Thank you.
Thank you. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.